Pat, $1 billion is a big number to start with. Very few funds have that kind of red carpet rolled out for them.
Yep.
So funds who are just starting, how do they do it today? In a time when Citadel, Balyasny, Blue Crest, Millennium have these massive platforms with huge back office, with all the compliance you need, how do guys start with their own firm and their name on the door?
It's tough. And if you look at the industry as a whole, it's even harder. If you look at the statistics, there's about 400+ funds that manage $1 billion or more. That's only 7% of the industry as a whole, but they control 80% of the assets of the total industry. So it's tough for any small or mid-sized managers, particularly the startups. To be successful in marketing, you have to incentivize investors on day one to allocate capital. So what you're seeing today is the rise of founder share classes, which is a break in fees or additional capacity down the road. You're also seeing seed relationships where managers give up a percentage of the top-line revenue share.
But if you've got to give a break in fees from the get-go, doesn't that start you off on a really bad path? Because once you give a break to one guy, you know, everyone is going to expect it forevermore.
It's your timeline. How quickly do you want to ramp up assets to get to an institutional size fund?
You want to sell your soul,
raise,
essentially?
Well, let's call it partnering with accelerators. To raise capital from pension funds, sovereign wealth funds, right, you need to have, let's say it's $100 million. They're going to rate a 9-figure check. They can't be more than more. Many pension funds, if they rate a $100 million check, can't be more than 10% of your fund. You're going to need to get to $1 billion, right? To access that marketplace, if you're getting a $100 million check from a seeder to give up 20% of your business, they'll get you there that much faster. Now, Stephanie, there's plenty of people that are raising money from friends and family, from past partners. It may take them a little bit longer to get to that institutional level, but if they're delivering alpha, if they're performing the way that they told their investors they would, they're going to be successful in the long term. It's just how quickly do you want to ramp up assets?
Once upon a time, you know, the saying went that all you needed to open a hedge fund was like a clever name and a Bloomberg terminal.
2 guys in a Bloomberg, yeah.
Yeah, so what does it take?
Or one woman in a Bloomberg.
Excuse me. Thank you.
I use guide generically, right? Today, what's the minimum in assets under management you need to keep the lights on?
There's no minimum. What we tell our hedge fund managers, though, is to have 2 years of operating capital before launching a hedge fund, right? And that's before counting on any fees, before any management fees or incentive fees. Have 2 years ability to run your business. Then from there, it's all about returning to your investors what you stated you would. I mean, it's all about knowing your value proposition and your objective for your fund. So if you're looking to return S&P level returns with half the volatility, go out there and do it and you'll be successful.
But are investors or potential investors even willing to look at startups? In the last 5 years, it just seems like the big guys, even if their performance isn't so great, just keep getting bigger. If I'm an endowment, if I'm a capital allocator, I know nobody's firing me if I give money to Citadel or David Tepper or Bill Ackman. So how does that help the new guy who's got some great, unbelievable strategy? Who really wants to take the risk?
So the success of the largest hedge fund managers in the industry, their success is allowing for a second generation of hedge fund managers because they're reaching capacity. A lot of the largest funds out there are shutting down their strategies,
like whom?
or
it
they're
seems
having
like
minimum.
Millennium, Blue Crest, their doors are open for new dollars.
There's a whole host of multi-billion-dollar managers that don't have capacity issues. But if you look at tech-focused managers, right, where they reach multiple billions of dollars, they have to close their doors to new capital, and that releases a new generation of hedge fund managers that are spinning out of some of the most pedigreed managers on the street.
Well, that actually brings me to my next question. That's where the new talent is coming from. They're coming out of the established funds because with the prop trading business effectively gone, you know, that's one source of talent for the hedge fund industry that just isn't there any longer.
So a lot of the billion-dollar launches come from pedigreed managers spinning out of some of the largest fund managers on the street, a lot of those.
What's an example?
Well, I don't know if we're going to mention names today in terms of hedge fund managers specifically that are launching, because there's a host of managers that launch that would not be quote-unquote pedigreed managers, but are able to deliver top-tier returns to investors, and those managers are going to be successful. So pedigree is not a requirement to be successful in the hedge fund industry. What's that?
Makes it a whole lot easier to raise money, doesn't it?
Investors like to allocate to portfolio managers with whom they're already familiar with. So if they had a previous relationship with that manager at an established fund that had the ability to repeatably produce alpha, they're going to be more comfortable allocating at an earlier stage.
I'm going to guess if I was a long-term investor of David Tepper, or wanted to be, because, you know, he's giving money back and he's got a guy spinning out, I'd probably be interested.
Yeah. Most investors probably would, too.
Congratulations. Thank you so much for joining us today. Patrick McCurdy, he's the head of Cap Intro at Wells Fargo.